Hello, welcome to the proposed 457F Deferred Compensation Regulations webinar presented to you by guest contributors Kirk Sherman and James Patterson of Sherman Patterson, with Toni Dolby, Managing Director and Senior Advisor of the Total Compensation and Rewards Practice of Integrated Healthcare Strategies. My name is Crewy, and I will be the moderator for today's webinar. We welcome you and include your voice in the conversation. So please ask questions using the question and answer panel on the right, and we will answer those at the end as time permits. Now I'd like to introduce our guest contributors. Kirk, our presenters with Sherman and Patterson, a law firm focusing on non-qualified deferred compensation, split dollar life insurance, benefit plans, severance arrangements, and employment agreements. Their 500-plus clients are primarily tax-exempt organizations. In 5 years at Integrated Healthcare Strategies, Toni Dolby has designed compensation benefit, retention, and severance plans for a wide variety of hospitals and health systems, from local community hospitals to the largest integrated delivery systems in the nation. Please welcome in Kirk, Jim, and Toni.
Good morning, everyone. This is Toni Dolby. Today we're going to spend some time going through the new proposed 457F regulations, what we think they'll mean to non-qualified deferred compensation plans, including SERPs, capital accumulation accounts, and a host of other benefit programs in place, and as much as we can help you with what we think the transition issues are going to be to move to these new regulations. I think the good news is that they are in some ways more positive than what we were led to believe the regulations would look like back in 2007. So it's been a long time coming, and let's hope that they finalize these more quickly than they did back then. So Sherman is going to start it out, and again, as much we'd love to get your questions and feedback, so please give us questions. I think there's a spot to type them in, and we'll try to respond to all of those. If we don't get to some questions, we will do responses and follow-up.
Well, Toni, for the introduction. And what we first want to begin with is just to get us grounded as to where we are in the tax world. So I may free you up actually here for an hour that you weren't expecting. There are two tax regimes that we're involved or that we're looking at. The first is for tax-exempt employers. If you're a tax-exempt employer, then 457F applies, and you should be participating in this seminar. Now, exempt here would refer to the actual employer for the employee. Sometimes in multi-corporate systems, there may be a taxable management company. And so what we're looking for is the person who is, or the entity that's the actual employer of the executive. And if that's a tax-exempt employer, then you're in the right spot. Now, if it's a taxable employer, a different tax regime applies. 451 applies. And so that's what we are not talking about today. If you have only employees employed by a taxable employer, then today's discussion won't apply directly to you. Obviously, you're welcome to continue to participate, but just know that that's where we're going to be from a tax standpoint. A little bit of history here. Now, I should say, if you've not yet accessed the PDF of the slides, the PDF also has presenter notes, and in the presenter notes is the substance of what we're talking about in each slide, so that you will, when you access them, have 90% of the content of what you're hearing today that goes along with the pictures. Again, the story back in 1986, when Congress first extended 457F to tax-exempt employers. Prior to that, it was there, but it only applied to governments. In 86, Congress said, let's apply it to tax-exempt employers. And it has primarily two rules in it. One is that anything that is deferred compensation is going to be taxable when it vests. And by vesting here, when there's no substantial risk of forfeiture. So you see SRF through the presentation. That's the concept of vesting, and if somebody is vested in a benefit, then the present value of that benefit is going to be taxable, even though it may not be payable until some point later on. Second thing 457F has is a listing of plans that are exempt from the rules. Severance being the key, a primary one of those. And so there are rules about 457F severance plans. Not well developed in 86. We're going to see those that in fact they will have more prominence. Well, 2001 Enron happened. Enron, of course, there are many other employers that were involved, but the situation was that we had executives that were using their deferred compensation plans as personal piggy banks. And Congress didn't like that. The key people were bailing out just before the organization went belly up, for example. And so Congress, in its wisdom, came back and in 2003 started the process of the new legislation going. If we can get the slide to advance here. So in 2005 to 2007, we had the IRS working regulations for 409A. Now, we are not going to talk about 409A a lot today. We raised it for two reasons. One is the IRS liked what it did in 409A, and so some of these concepts are going to carry over to 457F. More importantly, there's a great risk of confusion between 409A and 457F because they're going to use terms like substantial risk of forfeiture and severance plans, but they're going to have different meanings. And so let me plant the seed now, and then later we're going to see that grow, that concept grow, and the problems that could happen with that. And 409A generally, that as you're aware of it, this is as much I'll say about it, is if you violate 409A rules, which are largely time and form of payment rules, the participant incurs a 20% penalty. Something that we certainly want to avoid. So after 409A, then the IRS, liking what it did in 2007, said, we're going to do the same thing to 457F. We're going to give you regulations and new rules, and we're going to define substantial risks of forfeiture, probably like we did under 409A, and we're going to give you some rules about severance, again, probably like we did under 409A. That we will see ended up not being the case because 457F is going to be a little more friendly on both of those concepts than 409A is. Finally, now in 2016, we have the proposed regulations 9 years later. That's what we're going to be focusing on today, but notice that they are only proposed at this point. Law. It's going to take a period of time for them to become law. As Toni points out, hopefully it's before she retires, definitely, that happens. The first thing is the IRS has given us a public comment period that will end on September 22nd of this year. Those are September 20th, and when those written comments are in, then we have a public hearing that will be held about a month later. And we'll give the industry, the stakeholders, a chance to come before the IRS and Treasury officials and actually give testimony about what's right with the rules, what's wrong with the rules, what should change. At that point, the IRS will take all of that written and oral information and then issue final regulations. They told us the regulations will become effective on January 1st, at the year in which the final regulations are published. Now, we're being generous here. We have put 2000 and something in the teens. In speaking with the IRS, there is little chance of this happening January 1, 2017. More likely, what they would like to do is to have these out early in 2017 so that they become effective January 1 of 2018. That gives us, in all likelihood, at least another year before we need to be compliant with the regulations. Note, however, the IRS has said if you want to rely on the regulations now, you can, and we're going to do a couple of reasons why relying on them could be to your advantage in a couple of specific areas. The big question remaining now is what is the effect on existing plans. How is this law going to apply to deferrals? So if you have a pre-effective date deferral, and here's not a plan, it's an actual deferral that happens, a deferral of compensation, and that happens before the effective date, the old law is going to apply to that deferral even after the effective date. Gives us a type of grandfathering. We'll talk about it a little bit more, but the IRS was reluctant, as we spoke with them, to use the word grandfathering. They didn't want people to think that they had a free pass now on their prior plans, or confuse it and say that a plan was grandfathered. Because a plan is not grandfathered. It is only deferrals that would be grandfathered under this. So, for example, if you have a non-compete agreement, a deferral with a non-compete on it right now, you get a free pass. The IRS is reserving the right to come back and audit you, but if they audit you, they're going to apply the pre-regulation law and determine if your non-compete passes muster under today's rules versus what the rules will become after the effective date. If you make deferrals then after the effective date, whether the plan was pre-effective date or post-effective date, then the new law is going to apply to those deferrals. So here we do have grandfathering that will take place, and it was really quite an advantage. And just an aside, when we were talking to the IRS about this, recognized that the regulations in several respects were different than what they had been talking about. And they said their strategy at the end was not to talk about all the goodies and how friendly the regulations were, because they wanted the public not to be up in arms and to ease through the process now. So if we view this as a positive, all these things as positive, maybe we won't be as negative towards the IRS as we otherwise might be. We will, if in fact that plays out. So let me turn back to Toni to give us some indication about the plans that are affected by this.
I think for most of our clients, you have some sort of SERP. It might be a defined contribution plan or defined benefit SERP or a target benefit SERP, but some sort of supplemental retirement plan. A number of you have plans that refer to as capital accumulation accounts or SARAs, accumulation retirement accounts. Those programs would, of course, be affected. Probably less obvious is the economic benefit regime structure for split dollar. That's where the organization advanced a premium to the policy and later promises to transfer that policy over to the executive. And that's sure we'll need to look at what kind of risk of forfeiture needs to be included. Medical plans, if you have a promise to provide a policy for your executive, as I understand it, those would not be affected. But if you've got an allowance that says at retirement and provided you have a certain years of service and age requirement met, that you're going to get a $500 a month allowance in order to purchase the insurance, those allowances would be affected. And we'll talk about exactly how that vesting requirement and payment requirement would need to be dealt with. And as Kirk mentioned earlier, we really need to take a look at severance plans, which get somewhat complex because of the combination of 409A and 457F. So I'm sure there's other titles of programs that are in place, but anything where the employer is putting money away on a tax-deferred basis or an executive has been allowed to defer income or PTO days, for example, all of those types of programs would come into play under these new regulations.
So four of the main areas that are addressed in the 457F regulations are non-competes, consulting, voluntary deferrals, and severance. And these are all treated differently than we thought they would be treated back in the 2007 guidance that we received. Other aspects, there are other provisions in the 457F regulations that aren't as important for situations, so we're going to focus on what is most important. We'll also touch on some of the other provisions later in the presentation. So talking about non-competes, if it's the old standard, and by the way, under 457F, we actually weren't positive that non-competes even worked. We relied on a different section of the tax code to determine how the IRS felt about non-competes. And so one advantage of the new guidance is that for the first time we actually have guidance under 457F of the code regarding non-competes. But first, let's talk about how they worked in the past. We've always had a fact-based test. Enforcement has been required. So the facts and circumstances test would look at things like age and training and health to try to determine whether, in fact, the non-compete was real and whether it was substantial. The non-compete had to last for 2 years at least, and they've been used commonly for decades in the tax-exempt industry. There was fairly relaxed oversight. It was common for organizations to check in at the end and determine if the person's competed or not, and if they hadn't competed to pick up the benefit. Well, now is new rules with a non-compete that substantially raise the hurdle. The hurdle is much higher. What we have is on the employer side, that the employer needs to demonstrate that the employer has a substantial and bona fide interest in preventing competition. And a key factor that it would need to look into is, would it suffer a significant adverse economic consequence if the participant competed against the organization? Significant adverse economic consequence. So already that is increasing the hurdle. It's making it harder to determine that a non-compete would really qualify as a substantial risk of forfeiture and therefore defer taxes under Section 457F of the Code. Organization is also required to have ongoing efforts to verify compliance, not just with this non-compete under the benefit plan, but with any non-compete that organization has in an employment setting or other benefit plans. They need to be able to verify that they are treating these non-competes as real, that they will enforce them. And so there is an ongoing effort requirement to verify compliance.
So, Jim, if I might just jump in there, what the IRS is looking for, this enforcement of all non-competes, really is an indicator that competition or preventing competition is important to the employer beyond just tax deferral.
That's right. So that's the employer side. Now, as you see on the employee side, the employee needs to show that she has a bona fide interest in competing and an ability to do so. It's possible that someone would have an interest but not an ability, or they would have an ability but just not an interest. They're just not really interested in working anymore. Maybe they're 72 years old and they want to go do something else. So they need to be able to show both of those things. So the test is the same. They'll be looking at things like reputation, specialized skills, but they also have added another factor, and that is financial need. And it's not clear exactly how that's going to work. What exactly is financial need, and who determines that? It's a troubling area, and so we need to learn more about that one to determine how a non-compete would need to be justified based on this concept of financial need. So think about an example to apply this of a high-producing surgeon. And if this person, if he or she leaves, let's say moves 1,000 miles away, leaves the hospital and starts working somewhere else, that would certainly cause an economic consequence. It's significant. Perhaps it needs to also be because the person is competing against them. So it's not just suffering the economic harm that is the issue, but it is that they are competing against the organization, and the organization is suffering significant adverse economic consequences. So this is a higher standard than before. The regs give an example of a college sports coach, and it's pretty clear how specialized that person is and how difficult it would be if the coach quit. So that's an example that we have, and we need to try to interpret how the new standard applies in the healthcare industry.
Just a question there. So in your same example of a high-producing surgeon, if that surgeon instead was able to move 10 miles away to a competing health system and was going to be a surgeon with that organization, that would seem to indicate, if that person had that ability and interest to do that that would be a substantial risk to the organization and an economic risk to the organization.
That's right.
So the fact that that surgeon could have gone very close to them and easily have taken patients with them would argue that non-compete could potentially work in that situation.
Yeah, that's right. And Toni, you raised a great point, because non-competes will apply differently in different parts of the country, where some parts of the country have numerous organizations, numerous competitive organizations, and others do not. So it will really need to be looked at closely. Another element, another possible substantial risk of forfeiture is post-termination consulting. This also, though, is subject to a higher hurdle. It's more, and we've always known that it was more than just being available. That you couldn't just terminate and say, hey, if you need me, let me know, I'll come provide some consulting, otherwise let's defer my serve for a couple of years. It's never worked that way. Under the new rules, to defer taxes, consulting needs to be a minimum of 2 years, and hours need to be substantial in relation to the amount of deferred compensation. And the challenge with these new rules then is the bigger CERB, the bigger the deferred compensation, the consulting hours would need to be provided to make it qualify as a substantial risk of forfeiture. If the benefit's too big, then consulting probably will not work on its own to defer taxes. Before, we always looked at 20% as being substantial. So, for instance, if there was a CERB that had accrued and was $2 million at termination, 20% of that would be $400,000. If you look at someone perhaps that was earning $400 an hour, under the way we looked at it before, they would need to render 1,000 termination consulting hours to meet this test that it's substantial enough to qualify. We don't know if that type of standard will qualify, but it's something like that. And again, as the CERP increases, it's going to be hard to provide enough hours to make it work. Now to pass it back to Toni to application of non-competes and consulting to benefit plan designs.
So as long as we just were on consulting, let's talk about that for a second. So a couple of questions I would have for consulting is, first of all, there are some of your executives or physicians that perhaps would provide a lot of value to you to be available and to provide some consulting time post-termination, while others it probably wouldn't make a lot of sense. So I believe, just as it was in the past, that consulting would be a fairly narrowly used tool that might be very applicable for your head of your foundation who has relationships with donors and you want to help transition those relationships. Might work for a CEO or a CFO, but it's probably not going to apply for an assistant vice president in a specific area. Is that?
Yeah, you raised an interesting aspect of that. Even though CEO and CFO time and consulting can be valuable, just in practice, we find that the new CEO, the last thing he or she wants is the old CEO around, flirting in the corners.
Right.
So there's a practical limitation on this consulting.
And I guess a question on that, do they actually have to provide the hours where in the past it was be available for those hours? Under this area, do they actually have to work the hours?
Regulations do refer specifically to hours of consulting.
So I think that's a slight difference, and I think at least with most of our clients we've used consulting very sparingly, but it sounds like it is a tool for us to have available in the right situations. A lot of our clients pre-2007 had economic non-competes in place for everybody. From 2007 till now, we've moved away from using non-competes as new programs are put into place, but we still, I believe, have a number of clients that have kept them in place waiting for these final regulations to come into play. So I think for those of you that have non-competes in place for everyone, I think under the new design, we're going to have to look at whether we're going to have to switch to a cliff vest or an after-tax program for most everyone, but you may look at whether the non-competes might be appropriate for a select few of the participants. Probably could be your more senior executives or a specific skill set that somebody might provide, or for some of your more highly specialized positions. For those of you who have cliff vests and you put cliff vests in place or after-tax plans in place for everyone, I think you have the opportunity now under these proposed regulations to ask the question, are you comfortable staying with the cliff vest for everyone or the after-tax plan for everyone? Or should we look at moving some people to that non-compete or consulting structure for that select few? And as I understand it, that we could do that not only for new dollars, but we could actually, because we can rely on these new regulations now, you could potentially move already deferred into a non-compete for those folks that determine the non-compete might be a substantial risk. So, and I don't think this gives us a free pass to move back to non-competes for large groups of people, but gives us the opportunity to look at for those that they really would be appropriate. I think compete does give us some term retention ability because it makes long-term deferrals more palatable and more comfortable for people, and so that gives some retention value for the employer, and at the same time does give that longer-term tax-deferred earnings to those executives or physicians that we feel that can use the non-compete for. So I think each will want to look at your programs and having those kinds of discussions of, do you leave your plans as they are? Do you want to move some people to non-competes or consulting? And for those of you that have non-competes, again, I think we're back to going to have to move away from the non-competes for large groups of executives or physicians.
Toni, as you were speaking about taking the current dollars, you didn't hear all the 409A antennas going up.
Yes.
And people are, wait, won't that violate 409A? Yeah, you've got to retain the same time and form of payment as you do that, but there you can migrate those dollars from cliff to non-compete.
So just to be clear, if you had a 10-year cliff and you move to the non-compete, you'd have to stay with the 10-year deferral date. You can't accelerate that or push it out on those past dollars. You would be able to change from a cliff vest to a non-compete.
Right.
So this is sometimes the 409A and the 457F regulations cross over, and we need to be careful we're looking at both.
Another area that we have guidance on is regarding voluntary deferrals. Back in 2007 guidance, the service said we won't allow those anymore. You can't voluntarily defer and make those subject to a substantial risk of forfeiture. In 4A, that changed, and the IRS has followed this new trend to allow voluntary deferrals, but we need a 25%, or actually greater than 25% match on the voluntary deferrals for those to be considered substantial risk of forfeiture, or to be subject to a substantial risk of forfeiture. So the rule is that the present value of the deferred dollars must be more than 125% of the present value of the non-deferred dollars. The example in the regs is of an account balance plan, and the percent voluntarily defers a certain amount, and right out of the chute, the organization matches 30% that voluntary deferral. So that, the IRS says, works. That's what we're talking about, is it has to be at least 25% greater than that amount would have been. And so this is definitely, again, a higher bar to qualify for making voluntary deferrals deferred under Section 457F of the code. There's another element here that is a change, and that is that there's a 2-year deferral requirement for each dollar. So in the past, you might have been part of a deferral plan that had maybe a vesting date that was 5 years out or 7 years out, whatever it would have been, and you'd make deferral elections and be able to elect those on vesting date and then get paid. Now, say for example, a plan that would vest at age 65, the deferrals would actually have to stop at age 63 because any deferrals after that point wouldn't be deferred for 2 years. And so that's a change. That's a restriction that we didn't have before. And as an outcome of this, elective redeferrals are also treated as voluntary deferrals. And a lot of plan designs have elective redeferrals, one-time rolls or multiple rolls. And those will either need to be removed from programs or the employer would need to provide a matching contribution for one-time roll to work after the regulations are finalized, assuming they're finalized in this form.
So you're sounding like a lawyer, Jim.
Yeah, exactly. So there are a lot of ifs. Unfortunately, we're here today talking about proposed regulations, but we're doing our best to give you a sense of what the lay of the land is and probably will be in the future. So talk about voluntary deferrals, then, it does raise some questions. For instance, and these are questions we'll ask the IRS. What happens if a plan has say a minimum 2-year deferral, but then a participant can elect longer, like 5 years or longer? If they elect longer than the minimum, is that determined just at the creation of the plan? Is that then going to be treated as a voluntary deferral? Then clear at this point. What about PTO trades that are used for additional deferral dollars? We're not sure about how the IRS views PTO trades. And the flex plan itself, this notion of choosing between insured benefits and deferred compensation, even making an election under the flex plan because there's deferred compensation involved, will the IRS treat that as a voluntary deferral? These questions, among others that we have, with the comment period that Kirk described, and we joined with many others in the industry to be asking questions like those and trying to get more answers.
And Jim, as we look at those, I'll take the IRS approach, but in the flavor of regulations, my guess, my prediction is that all of these are going to be voluntary deferrals. We'll see. We may be surprised, but I'm guessing that if any of these elements are in your plans, they're going to need to be modified. Let's now move to severance. We're going to talk about, and the next two areas we talk about have the potential for 409A confusion. So if you could, for the moment, set aside anything you know about 409A, because we're going to talk about this only in the context of 457F, and then Jim's going to come back and tie 457F and 409A together in certain respects. Severance pay is exempt from 457F, meaning that it is taxable as received, not taxable when it vests. So qualifying as a severance pay plan is important from the tax standpoint. The rule was very undefined. We had to look to other areas like ERISA to determine what is a bona fide severance plan. General rule seemed to be if you only could get the benefit on an involuntary termination, then that's probably a severance plan. Whether it paid 1 times compensation or 3 times or 5 times, the general approach was you qualified for the exemption from 457F and could report those dollars in income as received. 457F regulations now give us much more definition. Allowed that a plan can have not only without cause termination, but also good reason termination. That's where an employer does something bad to the executive, and the then gives notice to the employer they've done something bad and a chance to cure. And if they don't cure, then the employee can voluntarily leave. And that seemed to be like a without cause termination. So something bad there might be a reduction in authority or compensation. Those now are definitely allowed as the payment provisions. Aside here, some of you may still have plans that were the old severance pay accrual plans, where instead of deferred compensation, people accrued an account balance or days of severance. And the thought was, we'll pay you those no matter when you leave. We're not going to condition the payment on you retiring. And people said, well, that then is a severance plan. This is clear now. The IRS issued a private letter ruling or a technical advice memo several years ago saying that's not the case. Now, with these rules, that will be the case, and those voluntary plans will need to be ended. Severance pay exemption will be capped, however, at 2 times total compensation. The total compensation is total taxable and non-taxable compensation added together. Anything of value that's being provided. Saying up to 2 times total compensation will qualify for the exemption, and it needs to be paid, the severance needs to be paid by the end of the second year after the year of termination. So that's different than 24 months. It could be up to 37 months and 30 days. So it's more than 2 years, but it has to be paid by the end of the third year. Let's look at an example of how this would work. So if a sample severance is that you're going to get 2 times total compensation and it's paid in 24 months, no, you're within both rules of 2 times total comp, and you're being paid the severance by the end of the third year, year 3. So what now happens if instead of 2 times we're putting 3 times total compensation? And so this 3 times total compensation being paid out over 3 years. We have now surpassed 2 of the limiters in the 457F severance pay definition. We're going beyond the end of the second year after the year in which termination occurs, and we're going above 2 times total comp. The news is you can still pay that. It's not a violation to pay 3 times total comp over 3 years. But what happens is any excess amount is going to be taxable in a lump sum as soon as it vests. So in this example, this participant at the time of termination would have to take into income 1 times compensation, actual income. And so that would mean that you would go to, you'd have 2 options for dealing with this. One would be to go ahead and distribute out the full balance of the extra 1 times compensation, pay that out on day 1, or you distribute out the taxes that were due on that 1 times compensation. The design of your severance plan may dictate which you do. If you have an offset for earnings during the second half of the severance period, you probably want to just distribute the taxes so that you can still implement the offset if somebody else has a job, or if it's conditioned on somebody not competing. Use the ability then to withhold those dollars if you only distribute out the tax amount. It's timing of taxation that's affected by 457F severance pay regulations. Now let's go to another concept easily confused. You'll notice the regulations have a 457F short-term deferral exemption. The short-term deferral exemption for 457F is available if you meet 2 criteria. The compensation is subject to a 457F substantial risk of forfeiture. So be cliff vested, could be higher bar, non-compete, could be post-termination consulting that makes that meets the substantial relationship requirement. If you have those 3 elements, and if you pay the benefit within a short term after the benefit vests, that's where the 2.5 months comes in, and short-term deferral comes in, the benefit will be taxed when received and when it vests. And so now let's look at the application, and here's one of the goodies. It's a small goodie, but here's one of the goodies that comes with these regulations. So let's say you have a plan that has a vesting date of December 31. We'll use 2016 in this case. You pay the benefit in January 15th, 2017, because it took time to liquidate the mutual funds and to get a payroll run and all those things that need to happen to get things in payroll. You did not qualify for the short-term deferral exemption. The fact the participant vested in 2016 means that the money has to be on the 2016 W-2, even though it wasn't paid until 2017. We've all been through those year-end fire drills trying to get money on the W-2 when you have that December 31 vesting. However, if the exemption applies, the short deferral exemption, now the tax on lapse of the substantial risk of forfeiture rule is gone, and the money is taxed when received. So with the exemption, the employer could run this money, and the employee wouldn't have to declare it on his or her tax return until the return for 2017. So that's a goodie, small goodie, but a goodie that the IRS has provided us. All right, just focused on now the 7F aspects of this. help Dan now how this relates to 409A.
All right, thank you. So we've got here two individuals hopping over hurdles, and so we've got one hurdle for 457F, we've got one hurdle for 9A. So we want you to remember that there are two separate hurdles to get over. Wish that the 409A hurdle was actually higher, because that's the point. If we get over the 409A hurdle, we're over 457F. But if we get over 457F, we're not necessarily over 409A. 457F section of the tax code applies to the timing of taxation, and it's important to understand that. Whereas 409A, we think about penalties, that 20% penalty that we've been talking about today. That definitely gets our attention. 409A is focused on controls within the plan. The notion, for instance, that if we have a time and form of payment set out, we can't change that because we want to. That is a control under 409A. So 409A and 457F have different purposes, have different hurdles to get over, and each must be considered. So let's take a look at a table that will help us to understand this. So severance plan. Kirk talked about a bona fide severance plan under 457F of the code, 2 times total compensation. Under 409A, however, that higher hurdle that I mentioned, it's lesser of 2 times total comp or the qualified plan limit cap for that year. And so it's possible then that somewhere down the road, someone will say, oh, our plan is a bona fide severance plan. So you have to worry about 409A or 457F. And we're trying to highlight today is remember that 409A still applies, and it might be that qualifies under 457F as a bona fide severance, but not under 409A. So the problem would be in a situation like that is if the payment terms changed under a severance plan, maybe the amount was lump summed instead of paid in installments, any portion that was subject to 409A that didn't qualify, and that would be potentially subject to 409A penalties. This is true with the exemption that Kirk talked about, the term deferral exemption, because again we have different hurdles. Under 457F, it's a 457F that we can use to qualify for the short-term deferral exemption. Under 409A, however, is that higher hurdle 409A SRF. So in sum, then, just because a plan qualifies as a bona fide severance plan or as a short-term deferral plan under 457F, it doesn't necessarily qualify under 409A. And that's something that you need to take a look at to make sure that you're complying with that section as well.
We're going to start wrapping up here, and we're going to get to questions in just a moment. Just some miscellaneous things that are in the regulations. There are non-severance plans. 457F also exempts things like death and disability plans, compensatory time plans, those types of things. And the regulations give us more definitions. Nothing surprising in there that we've seen. We talk about how if you have the benefit is taxable when the SRF lapses, and the present value is what is taxed. We now have some guidance about how to calculate that present value. There's always been this question that's come up, well, what if I pay taxes on a benefit because we think the risk of forfeiture has lapsed, and I ultimately forfeit the benefit because I competed and we didn't think it was a high enough standard, for example. Biology to other areas said you can probably take a loss deduction for that in the current year, and now IRS has come back and confirmed that. Said, in fact, if you've paid taxes on money that you ultimately don't receive because you don't vest under 457F, you can take a deduction for that amount from your current year taxes. There is a rule about exchange of benefits, and that any exchange after the age of deferred compensation, after the regulations become final, will not cease to be deferred compensation, and therefore will potentially have taxation in play. They give an example in the regulations of exchanging deferred compensation for post-retirement medical, where post-retirement medical normally is not taxable. But if you make this exchange, it will become taxable. An area to think about is exchanging deferred compensation for a loan regime split dollar. We're not sure, and I'll show this in just a minute. Well, we'll skip it when we come to it in a minute. That applies because under loan regime split dollar, there's never a point where the participant receives money that doesn't have to be paid back. So we're not sure how it would apply if it applied to the loan regime split dollar. Find their governmental 457B plan provisions that are talked about in the regulations. Nothing new here. This is just taking changes Congress made over the last 4 or 5 years, like Roth IULs, Roth contributions to governmental 457B plans, and putting some meat on the bones for those rules. They only apply to governmental plans. So if somebody comes to you and says, hey, I hear we can now have a Roth contribution to our 457B plan, if you're not a government, don't be down that path. You can't do it. It's only for governmental plans. So, open questions. We need to, as we've talked about, we're going to ask about PTO conversions, elective vesting dates, flex plan allocations, and exchanging CERP for $1, among other things. Will be questioned, but these are the key questions that we want to ask. Bring us home.
Sure. So I think for all of you, probably got some provisions in your programs that we'll need to take a fresh look at, either that you might want to get rid of non-competes for the large group of people, or you've got cliff vest in place or after-tax plans in place for everyone, and you might want to look at whether you can move to consulting or non-competes for some people. A lot of you still have PTO conversions. We don't think we know the answer about that yet. Elective deferral dates and re-deferral opportunities. So I think there are things that take away from this that we could probably get working on right away. Of course, we don't know what the final regs will exactly look like yet, but my suggestion is to not wait to start these discussions until after the final regs come out, because forbid they come out in December of 2017. The rules say that then start applying the following January. That means now we have 1 month to get plans in compliance. Great news if they come out in January of 2017 and we have 11 months to get ready, but we know that that's going to be the case. So for all of you, I'd suggest starting these discussions both internally and with your consultants, whether that's us or your benefits administration consultant. You'd want to start thinking about these ideas. Quite a few questions that have come up, so we'll start answering those, and please feel free to continue to put your questions on by email, and we'll get to as many of them as we can. And as we said, anybody that we don't get to, we'll make sure we respond to the group with information. The first one was a question of post-retirement benefits and post-retirement medical benefits in place for all our employees, not just our executives. Are those plans affected by these new regulations?
457F applies across the board to deferred compensation at any level. We're used to talking about it only in terms of the select group. But technically the rule would apply to a broad-based post-retirement medical plan. The only kind of post-retirement medical plan that you need to be concerned about, though, is one where the participant can end up with cash in hand, not as a reimbursement of premiums. So if you have a plan where you're going to pay people to go out and buy their own insurance, whether they actually do, for example, that would be a plan that would be problematic under 457F, whether it's for a select group or for a broad group.
But have a plan where your employees can stay as part of your medical plan, for example, after retirement, that would not be a problem.
Correct, no problem.
Whether that's for just your executives or physicians or your entire employee population.
Right.
Another question was on the cap for severance, the 2-time salary total compensation. Does that what included in the calculation of total compensation? And I believe, as you said, it's not salary and medical premiums, but it's any compensation, so salary, incentives, and sort of benefits, so cost of life insurance or disability insurance, pension plans, all that. So similar to how for those of you who work with us on total compensation, how we value total comp for IRS purposes of reasonableness would also come into play for the definition of severance 2 times salary.
So taxable and non-taxable benefits would be included in compensation.
So under that same scenario, just as an example, so if somebody has 30 months of severance, but severance only includes salary plus medical insurance and disability insurance, for example, that wouldn't necessarily, even though it's for 30 months, wouldn't necessarily cross over the line of 2 times total compensation because it's not including incentive compensation and a lot of other benefits. So before you think that that extra 6 months would need to be taxable at time of termination, we need to do a calculation of whether 30 months of salary plus medical premiums actually exceeds 2 times salary.
Yeah, that's correct, Toni, and I like the way you're talking about that. I always get, I don't like to see employers say, well, the 457 or the 409A, the 409A definition of severance is 2 times comp limited to the qualified plan, so we need to limit our severance to these amounts. That's not the point. You need to provide severance that's competitive based upon your situation, and then once you know how much it is, look at the 409A and 457F issues, which are easily dealt with. Don't those two tails wag the dog? You have tails on it?
Not any dog I've seen.
Let's hope not. Okay, another question was about the whole issue around non-competes. We're the only hospital in our community. Would it still be deemed substantial? Would it hurt us if the CEO left and went to another employer? Because we have to go hire a new CEO, so obviously that's a substantial cost and loss of productivity while we're looking for that CEO. Is sufficient to use non-compete, or would that not probably work?
You have to focus on the penalty or the pain of somebody competing, what they're going to take away from you, and be able to demonstrate to the IRS there's a significant adverse economic impact of the competition. The fact that it hurts when someone leaves emotionally and economically is not sufficient to defer taxation.
Lead us down the path that for systems or hospitals that are in communities where they're the only hospital in town, it's going to be more difficult to use the non-compete if the next hospital is 50 miles away.
Yeah, that's correct. And interesting as you say that, some have said, well, it hurts us if the CEO goes not only to a hospital, but also if they go across town to a meatpacking plant. And I don't know why meatpacking always comes up, but that's going to hurt too. Well, sure, and back to your point, Toni, it's going to hurt because of the cost of replacing, but the competition itself is not going to have that hurt.
Okay, so again, it leads us back to the path of using these non-competes are going to be a lot more really available to us than we thought pre-2007. Okay.
Another question that was asked is can you give an example of the voluntary deferral rules, how present value must be more than 125% of present value of the non-deferred dollars? I'm not following this. Let me take a shot at it again since I presented originally on it. I'll get another chance. So it is a tricky concept. One of the points here is that you can't just look at investment gain. You might have an arrangement, say $100,000 goes into this voluntary deferral plan, and 5 years later it's at $110,000. As long as that was a reasonable interest rate, that $10,000 is not part of this greater than 25% match that's required. Instead, what you need to be able to do is look at that future value, count it back, and the regs talk about discounting, so we have some guidance as to how this would be done. But the deferred dollars need to be more than 125% of the present value of the non-deferred dollars. So there actually has to be this big jump in the benefit. It'd be that the allows for greater than market returns. And so every year we could add a little bit of that in so that over time it got to 25% or higher. Remember the example in the regs where there's a 30% match right out of the chute. That's the concept, is that the service the IRS isn't going to consider these voluntary deferrals to be substantial risks of forfeiture unless benefit is going to be materially greater. And it has to be made materially greater by the company Otherwise, they say someone wouldn't voluntarily compete, and we don't want to allow those as substantial risks of forfeiture.
Okay.
So in your example, a $25,000 and $1 matching contribution would pass the hurdle.
Mm-hmm. Greater than 25%.
Going in at the beginning, or some equivalent excess crediting.
Another question was, when you're determining total compensation for severance purposes, I assume target incentive opportunity, because of course you don't know what incentives will pay, or would you need to look at historical payout?
Historical. Go back to the prior year.
Okay. So if you've got a history of paying at maximum and you've got time salary and severance, and you assume target for incentive payment purposes, you'd be okay, because last year you were paying at max.
Yes, that's correct.
But if you historically paid at 0 to threshold levels, assuming targets perhaps a bit risky.
Yeah, so you just go back to the prior year and determine what did we pay last year. That's what's going to help set the standard for you.
So it's the safest then to put in your language of severance that you're going to pay, yours would be salary plus last year's incentive opportunity rather than target or maximum or some form.
Well, again, depending on what you need to do from a competitive standpoint. And then if it's over the 2 times comp, well, either pay it up front or pay the cash. See, another question. A 457 SERP is in place and funding has occurred to date, but future funding dates past January 1, 18 will occur. Are all these payments grandfathered, or will payment after effective date be subject to the new rules? Yes, payment, it's the latter. Payment after, in this example, 1/1/18 would be subject to the new rules. It's happening under an old plan. It's a deferral after the effective date, and so it would be subject to the new rules.
Same scenario question would be, if you've got a program, as you've described, a SERP in place under 457F, and the regulations change as effective 1/1/18, would you freeze the old plan using the risk of forfeiture as you currently were and start a new plan that we don't have to worry about termination of programs or anything?
Correct. Yeah, just go ahead and build on, or you can continue on in the existing plan, just eliminating those elements that don't qualify.
So if under the old plan you had a program you vested in the account balance every 5 years, but you determined for new contributions that you can use non-compete for a person, for example, could plan so that you could set longer-term deferral dates, an example. You might want to say, we don't want to use a 5-year schedule under the new program, under the new rules. We want to use a longer-term deferral because we think we can use the non-compete for the CEO or that surgeon. Therefore, we're going to freeze the old plan and we're going to move to an age 65 deferral with a non-compete on dollars beginning after the new regulations came into play.
Right. Yep. Yes, that would be acceptable. Okay. We recently switched to after-tax 457F plans for executives. Is there a compelling reason to reconsider using a tax-deferred 457F? Question. What's interesting, if I were looking at that issue, I would first look at, do we have the basis to use a non-compete for the senior people? Or for whom do we have a basis for using a non-compete? And I would carve that out. It has advantages for the employer and the employee. Carve those people out. And for what you do for the rest of them is you've already discussed it. You've already decided you're going to go to after-tax versus tax-deferred cliff vesting. There is no reason to revisit that issue. It's just, for that situation, I would just look at other people we can carve out and use a non-compete.
Right. I think if you don't feel like you can use a non-compete for anyone, or, for example, if the people that you think you could use a non-compete for are at an age already that non-compete's not going to work for very long, it's probably not worth, frankly, the hassle of trying to recommunicate programs and changing your programs, and you'd probably stay with the non-compete. If you're a new person that you think is critical to the organization that you might not want to use a non-compete for, then you could go down that approach, that path for that particular individual. And I think scrapping your whole program and starting over, I don't think it's worth it it's not going to affect enough people.
Post-termination consulting, too, that could be another arrow in the quiver.
Yeah, good point.
It could work from.
I think we're about out of time. For anyone who has other questions, and I'm sure some of this raised more questions in your mind, we're always happy at Integrated to help with any questions that come up. And/or Kirk and Jim, you can call either one or both of us. For most of you who work with us, we're going to be in the process of, if you've got a review coming up on your program, we'll be talking about all this during that review. If you've just had a review and you're not going to have one another year or so, certainly you should talk about that before the next review, and feel free to contact us or we'll be contacting you. So I think for a lot of you, you've already kind of gone through this, moved to an after-tax plan or moved to Cliff Best, and you may say, let's just stay where we're at. That works under the new regs. But we'll want to make sure we look at severance and post-retirement medical and all these other programs. So I think on top of this, again, we all hope at this point the regs finalized by January of 18 so we know what we're dealing with and we can all move on. We don't know that that's going to be the case for sure or not.
Amen.
Okay, Toni, Kirk, and Jim, we'll be following up with all the participants and registrations with PDF of the slides as well as a recording of the webinar.
Thank you.
Thank you.
Thank you.